Good morning and welcome to the weekly teaser edition. So today I am going to be discussing with all of you the solution to question number 2. This question I had posted earlier on my social media platforms. For those of you who haven't read the question or want to refresh the question, I will be reading this question again for you and then discussing the solution. Meenakshi, a forex trader, observed that the spot rate is as under 0.12 US dollars per Mexican peso. Meenakshi also browsed through and found out that the interest rates are in the USA 4%, in Mexico 8%. The prevailing 1-year forward rate is $0.08 per Mexican peso. Question number 1. Comment on whether the foreign currency is over or undervalued vis-a-vis the domestic currency. Question number 2. Estimate the gain that Meenakshi can make by starting with 1000 Mexican peso. Before I jump into the solution, I'd like to discuss a direct quote convention with you, okay, because that will be a platform based on which the solution, or the premise based on which the solution is worked upon. So when I say INR USD is 65, it basically means that the price of a dollar is 65 Indian rupees. I repeat, the price of a dollar, which means the dollar is the foreign currency and behaves like a commodity. So this is the foreign currency. This is the domestic currency. The price of a dollar is 65 Indian rupees. In other words, in a direct quote, we express the price of a foreign currency in terms of domestic currency. So we need to remember this. In case of a direct quote, we express the price of a foreign currency in number of units of a domestic currency. In this case, the price of a US dollar is 65. And why is this convention important? Because when we are trying to find out the zero arbitrage foreign currency price using the interest rate parity, we will have to use the direct quote. So if you look at this particular illustration which is given to you, this illustration, the rates are as under. USD per MXN is equal to 0.12, which means what does it imply? This basically means it expresses the price of the foreign currency. In this case, the foreign currency is Mexican peso, in number of units of domestic currency, and the domestic currency is therefore dollars. So for the price of the foreign currency, which is in this case the Mexican peso, is 0.12 US dollars, and this is your domestic currency. So what we have just identified now is that 1 Mexican peso will cost you 0.12 US dollars or 12 cents. Therefore, US dollar is the domestic currency, and the currency which behaves here like a commodity is the Mexican peso, and that is the foreign currency as per the direct quote conventions. Having said that, let's also spend some time in finding out what should be the zero arbitrage forward price. Now, you know, by way of my earlier videos, I have explained to you that the forward rate is nothing but the spot rate multiplied by 1 plus risk-free rate in the domestic country divided by 1 plus your interest rate in the foreign country, provided that this quote is a direct quote. Okay, so if you substitute in the formula becomes 0.12 multiplied by 1 plus rate in the domestic country. We just identified that the domestic country is US, and therefore the domestic currency is USD, foreign country is Mexican peso, and therefore, the foreign country is Mexico, and therefore the foreign currency is Mexican peso. And the rate in the domestic country is 4%. The rate in the foreign country is 8%. So substituting those in the formula, this becomes 0.12 into 1.04 divided by 1.08. Now if I do this calculation here, what do I get? I get 0.12 multiplied by 1.04 divided by 1.08. So this is your zero arbitrage price or the intrinsic value of the foreign currency. Let me kind of denote that for you. The value which we just obtained is the intrinsic value or the zero arbitrage price. Okay, I think it's relatively fairly clear now. And we just observed that the zero arbitrage price is 0.115556. Whereas if you see now in the question, it is given to you that the prevailing 1 year forward rate is $0.08 per Mexican peso. Remember, there is always an inherent tendency, let me increase the size a little, there is always an inherent tendency for the market prices to move towards IV, intrinsic value or zero arbitrage price. Now, if you look at the zero arbitrage price, it is 0.11, whereas the current market price is 0.08. So it's very clear that the foreign currency is undervalued. Because the foreign currency is undervalued, how did we know that? We simply knew that by doing a small exercise, and I'll do it for you so that it's relatively clear in your minds. We know that the zero arbitrage price is 0.11556, and we also know that the current market price is 0.08. We also just discussed there is always an inherent tendency for the market prices to move towards the intrinsic value or the zero arbitrage prices. Therefore, you can see that currently the foreign currency is undervalued as the prices are expected to increase and move towards the intrinsic value or the zero arbitrage price. So we determine that the Mexican peso or the foreign currency is actually undervalued. Now that you know that the foreign currency is undervalued, you will take two positions to exploit the arbitrage. You will always go long in that currency which is undervalued. So you'll go long on the Mexican peso in which market? In the forward market, because the forward rates are clearly undervalued. And you will just take the opposite position on the same currency in the spot market. So you'll go short on the Mexican peso in the spot market. What are you going to do now? The question tells you that you start with 1000 Mexican peso. So we already answered the first question. The foreign currency is undervalued. Second question, how much money can we make? We're starting with 1000 Mexican peso. So we start with 1000 Mexican peso. Remember, we don't have the money, so we'll have to borrow it. So Meenakshi will borrow 1000 Mexican peso at what rate? At the rate which prevails in Mexico, which is 8%. So Meenakshi borrows this money, and the moment she borrows this money, she executes the first strategy. Does she? Yes. The first strategy is going short on the Mexican peso in the spot market. Okay. In fact, that's why we have started with Mexican peso, because we need to short it in the spot market. So I will sell the Mexican peso in the spot market. You know that the current spot rate is how much? The current spot rate is $0.12 per Mexican peso, which means every Mexican peso is going to fetch you $0.12. So 1000 Mexican peso will fetch you how much? 1000 multiplied by 0.12, which is 120 US dollars. So that with that we have executed the first strategy. I'll put it in a different color. So now we have just executed our first strategy, and we have converted the Mexican peso by shorting the Mexican peso and converting it into dollars. Now what do we do with this 120 US dollars? We invest it in the US markets at what rate? At 4%. So we do that at 4%. What do we get at time period 1? This money will grow to how much? This money will go to 120 multiplied by 1.04, which is 124.8 US dollars after 1 year. After 1 year, remember we had also entered into a contract at inception at time 0 for going long on the Mexican peso in the forward market. So now it is the time to execute the second strategy. The second strategy is going long on the Mexican peso in the forward market. So now what we need to do, we need to buy the Mexican peso in the forward market using the dollars. Remember, we have entered into the contract at 0.08 per Mexican peso. This was the forward price and this was undervalued. That's why we have gone long. So we have executed the contract to buy Mexican peso at $0.08 per Mexican peso. So to buy 1 Mexican peso, you require $0.08. But you have $124.8. So how many Mexican peso can you buy? You can buy 124.8 divided by 0.08, which is 1,560 Mexican peso. Now remember, we had borrowed at time 0. We had borrowed 1,000 Mexican peso at 8%. So the bank will come knocking on the door and we need to pay the bank how much? We need to pay the bank 1,000 multiplied by 1.08 to the power of 1, because this was borrowed for 1 year. We need to pay 1,080 to the bank. So how much is the surplus? We have 1,560 Mexican peso, out of which we'll pay 1,080. So the remaining 480 Mexican peso will be our surplus. So with this, friends, we have answered both the questions. Question number 1, comment on whether the foreign currency is over or undervalued. We found out that the foreign currency was undervalued. Hence, we took long position in the forward market for the Mexican peso, and we were able to make a gain, which answers a second question. Starting with 1,000 Mexican peso, we have actually made a gain of 480 Mexican peso, which is roughly 48% return on investment in 1 year. With that, I finish answering this question. I hope you enjoyed the solution. By all means, pass me the feedback if you want to learn it in a better way going forward. And stay tuned to YouTube channel Concept Canvas for even more questions and even more videos around even more interesting topics. Thank you very much and happy learning.